definitely instilling humility is that this is a niche skill set, grant research and writing and management space for local cities. And there's a reason, think about this, right? I mentioned it's not very fragmented. There's not a lot of competitors out there, right? Well, that's not great. That means there's also not a lot of people who know how to do this. And it is a niche skill set. So I definitely didn't have as full of a grasp of how tough it is to really build that talent.
Just want to introduce you a little bit to the group. This is a GoBundance group. It's full of amazing guys that are mostly investors. There's a big mix of real estate and business investors. This particular small group is mostly focused on business acquisition, and it's a probably some of the guys are either have done acquisitions and did exits. Some of them are in the process of acquiring businesses. Some have holding companies and own multiple businesses. So it's a really good mix. Some guys are W-2 and want to exit through an acquisition. So it's a really good mix of guys that are both investors as well as searchers. And 100% are self-funded. So there are no traditional self-fund type searchers. So I'd love to hear a little bit of your story, Jordan, and then how did you get to SIG?
Yeah, thanks, Jay. So that's great to hear. We're clearly biased towards the self-funded methodology. So just tell you a little bit about SIG, and then also go to my background as well. So SIG was founded in the fall of 2020 by three folks, myself with two other business partners. All three of us had run a self-funded search to buy a business, with the intent to raise equity once we found the company that we were going to buy. So we self-funded our own search. I mean, that just means you have to, bootstrap your either home office or a lean kind of office setup. Nobody's paying you a salary. And we did it full time from the standpoint of we didn't have any other sources of income. So it was a full devotion to finding the one company to acquire. So three business partners, myself included, started SIG after we had successfully purchased our own companies, with the mission actually to help other self-funded entrepreneurs do the same thing. And so we raised equity in each of our deals from a group, a consortium of investors, and we've continued to bring that consortium and build that consortium out and align them behind kind of a consolidated mission set around a certain type of deal. I mean, really, I think what is characterized in the 12 acquisitions that we've supported entrepreneurs to successfully close and become CEO and majority owner of, in most cases, it's really across industry. There's not one specific industry or one specific geography that is component of an SIG deal. It's really more about business model, valuation, and transaction structure. I think that's a better DNA for what an SIG deal is. So the firm, basically, we're really advisory and support, and also investors ourselves, and then co-invest alongside our investors that are in our group, if you will. So the advisory and support consists of, there's two main programs. So there's the full-time support program, which is a rolling selected, essentially a combination of services. So there's a weekly one-on-one call with one of the SIG partners. You also have essentially full access to our senior associate who's a full-time employee with us and has private equity background and experience. We do as well, but most importantly, have supported 12 acquisitions. So really, that's the big advantage, is you're not searching as a first-time business buyer. You're searching as partnered up with people who've done it before and know where the traps are and can help you just move as fast as possible and efficiently and effectively as possible. So that's the full-time support model. We have the capability to take on up to 2 searchers per SIG partner. So we have 3 partners, so that's 6. We have to keep it limited because it's a pretty full devotion of our resources and time. The other program is the post-LOI support. And that's where a self-funded searcher will will go out, do their own search. We're not, coaching or tactically supporting them at a full-time basis. They can be part-time searchers. They could have a job and spend, let's say 20 hours a week searching. And they could be geographically constrained and say, you know what, I'm only going to search around 50-mile or 100-mile radius of the city in which I live. You can do that. And then as soon as you get an LOI executed with your seller of a business, you and your seller, then just people email it over to us and say, hey, would this fit? And we do have criteria. We can go through that, but that's the two main possibilities where we can work together. And in either case, once the LOI is signed up, the tempo speeds up. We walk through the whole phasing of the transaction, and perhaps most interestingly, bring all the equity to the deal. So we don't take somebody on unless we believe we could actually get it done. And we've never failed in that setup so far.
So let me go backwards. So the consortium of investors, are you raising money from multiple private investors, or you have a group private equity or family office that you're raising money from?
Good question. So most of our investors that come into our deals. So what happens is we have a deal. Let's say that so one of the searchers that we've been working with has gotten under LOI. It's a good deal. Let's say it's being purchased for 4.5 times cash flow. And we've gotten initial indications from the lender about what amount of debt there is. And so we've squeezed it down to figuring out how much equity we need to complete the transaction. Let's say it's a $1.5 million equity raise. So what we'll do is we're going to go out to our group of investors to ask them if they are interested in investing in this deal, and provide information, provide models and a data room with supporting documents so they can conduct initial analysis, and then jump on a call with the searcher, the entrepreneur who's going to take over as the CEO. And pretty much after that, and review the data room, tell us whether or not they're in or out and for how much. And so it is kind of I'd say a pass the hat type situation. And we have people who really come into essentially every deal we bring out to market to our group. And then we have other people who may do 1 or 2 deals a year. And then others who are like, hey, I'm just kind of dipping my toes in the water and I'd like to just get exposure to this. I'd like to see some things. So we have a mix of people. And there's a couple of family offices. Most family offices will not set up for this. It's a very popular structure that's getting more popular with the potential candidates who are buying businesses, because through preferred equity, they enable themselves to maintain majority equity control. A lot of family offices, if they're going to put in the whole equity check, 1.5 million, they don't like that. So that's why we exist. One of the bigger reasons is we find people who are willing to accept 30, 40+% IRRs on their money, but are not obsessive compulsive over the whole, well, I don't have control kind of thing. You got to be willing to kind of let the searcher CEO take over essentially almost complete strategic, operational, and financial control. So a couple of family offices, mostly high net worth former operators.
What size checks are you taking?
Yeah, so typically the minimum check would be $50,000 per deal. And as mentioned, right, it's an opt-in. So we would show you the deal and you can dig in as much as you want. And then say, all right, I'm comfortable. This looks good. We could see an equity term sheet and sign it up. Some of the more, the active ones, we have people in the $100,000 to $200,000 per deal range. We have others who contribute higher amounts per deal, but in any case, 50K is the minimum.
And what is the structure of the deal with the investors?
In terms of the
like the whole time.
What part?
Oh, hold on, I got a question here. So what size deal, any industry specialization? Hold on, once you go in, Brian.
I didn't want to machine gun you with a bunch of
no, go ahead.
A bunch of questions. Right. So I think it's a really interesting model, what you're talking about. I haven't heard this type of model before. It's sort of a advisory plus or private equity light is sort of how I look at it. Sort of interesting model. So what size deals have you guys done so far? And is there a specific size deal that you target? Are you aspiring to go bigger? Do you want to stay small? What does that look like?
Yeah, so the average size company has, over our first 12 supported acquisitions, has been 1.9 million of EBITDA. So they are larger. Well, depends on where you're coming from, right? But these are not small, tiny Main Street businesses. I would describe them more as pre-lower middle market private equity stage. So the type of transaction typically is, a founder owner who's looking to sell the business, but really does need somebody who's going to have their butt on the line, really, to take over and transition the day-to-day of the business and institute basic protocols, processes, hire operations, finance, admin, support staff, really build it out to ultimately look like something that's probably a lower middle market, private equity style company that has doesn't have as many single points of failure across the organization. So
you said 1.9 million in EBITDA.
yes,
that's your average size. Okay. And then is there any industry specialization there? I assume your searchers are looking at all different types of industries, and is there any specialization? You do software. What can you give some examples of some industries you guys are in?
Yeah, I think I can share. So on our website, I'll do this real quick. Let's see here. If you go to our website and you go to the companies page, we have right here, searchinvestgroup.com. You can see the companies in a brief description of what we have supported. So this is essentially linens as a service company for restaurants and hospitality. It's pretty cool. So they manage the full life cycle of that and have great recurring business. This is home health, home care, hospice. This is roofing, repair, replacement. This one is traffic control services. Think of it as like outsourced from the utilities like PG&E, and they need people to man the signs and signals for those for like roadway construction. Another roofing, home care, home health, hospice. This is a specialty pharmacy. This is an industrial equipment distributor, telecommunications installation, service, and maintenance, niche food distribution in Austin, Texas. And then the company I bought up here is a local government grant research, writing, and management company. So, so there is not a defined kind of characteristic of what we would not be able to do. It's more a matter of valuation expectations. So oftentimes the sellers of software-based businesses or high-tech businesses are going to demand multiples of annual recurring revenue, which kind of break the ability for us to get to work. Typically, we'd like things that are 5 times or below, no higher than 5 times EBITDA. And yeah, so I think you could describe us as value-based, like value approach, with opportunities to grow, but that's up to the new CEO to take on. Oftentimes the company, it hasn't been growing at like 20% a year, for the past couple of years, maybe more like 5 to 10%.
Okay, so that's interesting. So Wesley just put the deal structure that you guys do for the equity investment after close. So, with these types of businesses, they're not very liquid, right? So you're going into these with the expectation that they're building it to exit, or you're doing with the expectation that they're going to continue with those EBITDA margins and do distributions? Or what's the exit strategy for the investors that are going in?
Yeah, it's a great question. So the investor has to be comfortable with either outcome, and in many ways see the advantages of either outcome, right? So I'm an investor in these deals as well. I put my own cash in, and somebody who's gonna run the business, grow it, right? That's the first step. You can do that. Now you have options. So you can seek to sell it to a strategic or a private equity firm. But more likely than not, these types of deals are actually more long-term hold in nature. So what happens is they start distributing cash. And the way for the CEO, the majority owner, the searcher who became the CEO, to really get wealth out of the company and wealth in their life is they're going to have to do distributions or get an exit. So every time they distribute, the investors are getting their pro rata portion of that as well. So there's a heavy incentivization for that. Thinking of it as like, if somebody wants to own a company for 10, 20 years, and I'm an investor and I keep getting checks in the mail for distributions, and we still hold the asset. And it's growing, it's built up from, let's say, $1 million in EBITDA up to 5 million over some time period. That's a great outcome. Now I have an asset on the books. I'm still raking cash in. I like that model a lot. That being said, I wouldn't be surprised that out of the 12, maybe 2 of them, 2 or 3 over the next couple of years, seek an exit. I think it's a large majority of people are probably going to end up running these businesses and doing distributions annually.
Okay, so given that your value as an investor is relying on distributions, and you're a minority shareholder, right? What levers do you have to ensure that management is operating the business responsibly? Do you have a board seat? Do you have the ability to replace management in the contract? How does that work?
Yeah, let me actually, before I answer that question too, describe, there's a standard provision in all of our deals where at any time, actually, investors can offer to sell their equity back to the company. But there's a standard provision of at the 5-year mark, it's more official. It's more of like an official put call option where essentially the majority owner or the CEO will say, hey, I would like to offer to purchase shares to consolidate equity in the company back from investors at X price. And that can be determined via an independent business valuation. And ultimately the investors have to say, one by one, say either they're in for that or they're not. And so you can get an exit without the company itself exiting. A good example, we do have some case studies, but a good example is one of my business partners had an investment in a self-funded search deal, and they offered to buy him out. I think it was like it was like a 5x MOIC or something. Nearly 100% IRR over a 2 or 3 year hold. And he was like, sure, I'll sell, so can't promise that, but I mean, that's the idea, is that you have an option to sell, even if the CEO doesn't want to exit the company himself or herself. So that's the first thing to note. And then in terms of the control provisions, there's pretty standard, anti dilution provisions to protect investors' interests, but also the majority of the investor group will elect one person to be on the board of the company to represent, of course, investor interests. And it's often somebody that the CEO feels that has a really good industry background as well. So if you're doing a roofing company, hopefully the board member is an investor who really likes the company and has come from that industry or has experience in it, or maybe home services, and can actually lend a lot of expertise in those board meetings.
Hey, Jordan,
awesome.
can you also talk to the structure once you bring investors of the LTV that you put it, how much debt versus equity are you guys looking, and if it's flexible depending on the amount of interest you have and other considerations?
Yeah, so great question. Given that we are very conservative on valuation paid, purchase price paid, and we're pretty disciplined about that, we're able to put a relatively larger portion of the purchase price into debt while maintaining a debt service coverage ratio and liquidity metrics that are plenty healthy. So oftentimes our transactions end up being 80 to 90% debt LTV, and you're squeezing down to a lighter equity check, and we're still closing at, let's say, 1.6 times debt service coverage. Plenty, the lender's safe, lender's comfortable, and there's actually still plenty of residual cash flow to hire, to grow, to build out the team and everything. So, but that actually enables, as we all know, returns. These are leveraged buyouts, and we buy companies that we believe are going to be conservative and safe, and yet also have the upside opportunity to enable that CEO to grow them. So that's how we kind of think about it when we structure it up together. Now, obviously, we can modulate the model, around the edges a little bit, but the opportunity to deliver kind of our, bread and butter of what we do just starts to degrade as you get away from kind of our core type of transaction and type of, purchase price and transaction structure. Does that help answer
Can
the
you give us an
question?
Yeah, can you give us an example from the 12 transactions that you've done?
And yeah, and I also wanted just to check, because in your study, when you look at the the debt that is taken, and do you go through also SBA loans mostly for the debt, or some other ways? And in your study, when it's a larger deal that is 5 times multiple greater than 5 million EBITDA, it tends to have less debt. So I just was wondering where the finances was coming from.
Yeah, so most of our deals start with a base of SBA 7A debt up to the $5 million max, and as needed, some of those lenders do offer essentially stretch loans from the bank that are pari passu on the same terms and length of duration as the SBA loan itself. And then beyond that, I mean, there's a lot of other options, right? We have commercial debt, mezz, sub debt. So we can go to a lot of different places. We've built some good reputations and relationships with folks that are flexible on that structure and are willing to come into that level of the capital stack. And yeah, and then whatever's left is going to end up being equity. So, but yeah, most of them do start with a base of SBA 7A.
Anyone,
Wesley,
any other questions?
did you want to share something about? We might be able to pull up something while that shows like an example, of a transaction. I think that was like the question.
Yeah, absolutely.
Yeah.
Let me get something here.
Also,
if
do you
anybody
have
else
any
has any
deals
other
that
questions.
do you have any deals that you're raising money for right now?
We do. We have one deal right now that we're currently in equity raise mode for.
Can you share some of the details?
Wesley, why don't you pull that up?
Definitely.
Just like
yeah,
the high level summary for the current deal.
While you're pulling that up, I've got a question about from the investor side. There's some like angel investor groups in my area that people essentially pay like a membership fee to get looks at deals, and then they I think have to invest a certain amount every year, or maybe they don't if they're paying the fee. But is that how you operate with your investors, or you just give them all the options when they come across? Like, what expectations, if any, do you have on your investor list?
That's a good question. So no, there's no fee. Really, it's a pretty select group. So we do qualify investors, and what we're primarily looking for is a couple of different things. Background. What can you bring to potential companies as an investor and or potential board member. But even before that, it's capacity, capability, and really dedication to kind of investing in this. There's a lot of people who could, as we all know, right, could look at deals. You look at them, you keep looking at them, and now we're spending a lot of time. Everyone's looking. We need people who are like, all right, I get it, I get the model. I like the type of industry, the type of transaction structure, and you guys just send me deals. I'm going to get after it. And that's what we need is someone who kind of is over that bridge. And now all they need to do is focus on who's going to operate this company and whether or not they like this industry, for example, this one, and then and whether they like the valuation and like the terms and but you got to basically be comfortable with let's say the $1.5 million equity check coming into the company is predominantly not going to have majority of the common equity. It's a preferred equity structure. So investors are getting their capital back plus a preferred return. And then on top of that, they're getting a component of the common equity, but it's in whole a minority portion of it. So if you're comfortable with that part, now you just need to look at the industry, the operator, the business itself, the valuation, and the return profile under a reasonable base case, like a reasonable conservative projection that's not crazy, and then just give a thumbs up and go for it. So we're really trying to identify that. I mean, who can kind of fit those buckets. So yeah. Is that helpful?
Yeah, it's good. Thank you.
Okay. So Wesley, yeah, you want to just talk through this one a little bit?
Yeah, absolutely. So this is a high-end printed circuit electronics printed circuit board manufacturer. They specialize in, high mix, so not just one product, but a variety of products with low to medium volume for across all stages of the product life cycle. For this reason, they're not as replaceable as going to offshore. They are seen as a partner in their client's development process, as they have to be able to be highly flexible and change specs at the customer's demand, which there are other competitors in this space that do the same thing, but they tend to be less than 5 million in revenue and working with maybe half a dozen clients. So Dave has, the buyer of this deal, extensive experience in this vertical, has direct hands-on experience in the company, and through his relationship with the management team, agreed to purchase the business from them. Originally at 10 million, but because of outperformance in 2022, has increased the price to 11.5 million, which is about a 3.5x multiple. Given an overview on the customer here, you can see that it's relatively diversified in markets. The customers on average, the top 5 customers here below, have over 10 years of tenure with the business on average. And they've also demonstrated significant stickiness, right? So, customer number one, frankly, it's just cost prohibitive for them to go to anyone else due to the amount of investment that's required to get the business up to speed. Going to customer number 3, there is, they produce military products, and, to get the registration, and to replace the supplier, the process is, time and cost prohibitive. Because essentially you already have to have this requirement and be in that area, which currently we do not believe any other businesses hold that requirement. So, moving forth, customer number 4, for example, has a history of acquisitions in their business, and when they do complete an acquisition, they move all volume to the current target. But that's to say, kind of looking to the debt service coverage ratio here, you would think 90% leverage on purchase price would be running pretty thin, because of the SBA's 10-year amortization period and the fact that it amortizes like a mortgage, and also the fact that the seller provided a seller note with highly favorable terms, a 15-year amort, also amortizing like a mortgage. Your debt service is well above the requirement for the SBA to give you that extra excess bank debt on both a TTM and a go-forward basis. For those of us who like to take a look at fixed charge coverage ratio, the CapEx is truly minimal. So your fixed charge coverage ratio is also well above, I think it's 1.4 or 1.5 in the closing period. So, very healthy, stable business that, and on this deal in particular, requires 1.8 million of equity, and we're giving that equity a 15% preferred return, and 100% of that equity is expected to be paid back by the end of year 2, creating a 0 cost basis asset to Jordan's point, and they convert to a minority of common equity to generate residual cash flow streams. And because the quick payback period is so quick, the projected IRR on this deal is 48.5%. While the MOIC is only 3.3x, because you're getting your money out of the business very early on in the operation.
Yeah, that's
Hey,
a good
Wes,
point, Wesley, which is just that's a key component, is the operator is pretty well incentivized to pay back the preferred capital relatively fast. I mean, it is PIK. I mean, they could let it sit there. It's going to accrue, and it's going to accrue on itself. But that cash return back and creating that zero cost basis ultimately, so that they no longer owe you any more preferred return, but now you're just going to be juicing common equity out as distributions. So yeah, go ahead. There was a question.
No, I was just wondering how old is the business? Because obviously there's a significant ramp up, like every business who's trying to sell post COVID, and so just to understand that it's not just an outlier,
Definitely.
COVID effect that is going to revert back to a mean because
Definitely,
you're paying
yes.
up at the top. How old is the company?
Business is 20 years old. It's been owned and operated by the same family for that entire period. Dave joined the company in 2020 and really helped the engineering team with process, workflow, capacity improvements. And so this is, understand your point completely of, hey, is this, temporal COVID effect? This is a unique situation where the operator is actually in the business, has seen the improvements be made, and can personally attest that this is sustainable performance, because at the end of the day, and this is a very strong underwriting perspective of many of our investors, he's personally guaranteeing the debt. If something goes wrong, while investors can lose money, he goes bankrupt. So it's not him stretching to get a valuation, or the sellers are like him and highly incentivized to make sure the business continues to perform. But agree to your point and on the COVID bumps, that is one of the first things we look at, and also what our lenders look at. And we stay away from those like the plague, frankly.
Yeah, if we wouldn't look at the end of the day, if we wouldn't personally sign up our own cash, and we wouldn't, put our reputation on the line as well, because I mean, these are going to be tied to us whether we want to or not. It's going to be tied to our brand. So we wouldn't do it. We're not bankers. We're not like selling something and then all of a sudden walking away. Like this is it goes on our board.
And are you guys investing as well?
Yeah. So we personally invest our own cash as well into these deals, co-invest alongside everybody else in the same investment stack of the deals. So I want to see my money grow.
Is there a GP-LP structure that you can talk about?
No. Nope. It's one capital structure type. So it's let's say you're doing a $1.5 million equity raise. All $1.5 million is coming in as the preferred equity. So it's going to get its capital back plus the return, and then a component of the common equity split.
So there are no fees. There's nothing. There's no structure where there are fees taken out of the deal or anything.
Yeah. So think about the IRR that Wesley was talking through here, and the MOIC. That's net coming to investors. So what makes this model unique is that you have the operator is negotiating essentially a split of effectively the preferred equity return level. Is that going to be a 8%, 10%, 15%? I've seen as high as 20% annualized return on the preferred capital. And then what does that mean for the associated split of the common equity between the operator who's taking over the business and signing the personal guarantee and the investors? And ultimately, what gets you back out to, let's call it, depending on the industry, depending on the risk being taken, depending on the market. I know we're in a different market now. 30 something percent, 40 something percent IRRs. Probably a little bit higher is going to be expected for a business that's in an industry that's relatively more competitive or doesn't have as much growth opportunity, and vice versa for the opposite cases. But that's the idea, is there's no firm sitting in between managing this portfolio or managing this company. It's really the CEO is able to secure more of the carry, if you will. Does that make sense?
Well, I'm not 100% sure. So are you saying, like, so you get a portion of the equity? Let's say you come up with 10% of the equity. You will get a preferred equity for that percentage. You get a preferred coupon, you said, on a yearly basis, and then you said, so there's kind of a split, so that equity, if you bought 10% of the company, you will get 10 like 80% of 10% if the owner takes, or whoever else takes 20% of the upside equity? Is that how I'm reading it, or?
I'm not sure I'm
Jordan,
fully following the structure there.
No. Yeah.
Jordan, I can take that if that's helpful.
Okay. Yeah, go for it.
Let me pull up a simple waterfall, everybody. This is very high level waterfall, but it doesn't always work like this, but just to kind of explain how investors are getting their money back.
This is
All right,
interesting
so-
because we didn't set up this call to be investor focused, but it turned out to be, but it's great.
All right, so here's a hypothetical transaction, and so 1.5 million of EBITDA, 4x multiple, 6 million of enterprise value. Call it 300K of transaction fees and cash to the balance sheet. 6.3 million of total sources. At 90% loan to value on total sources, you need about $5.7 million, or you can get about $5.7 million. Call that SBA plus pari passu debt, which means you only need about 600K of required equity. So this assumes 100% of cash distributed out of the business goes to equity investors, but let's go, 0.8, which is how our operating agreement actually works. So year one cash flow assumes no growth, EBITDA stays flat, 1.5 million. Right now, based on today's rates and SBA terms, about 16% of the principal outstanding is debt service. That's both interest and amortization. And so you can see here, of the 5.7 million, 16% of that goes to debt service. Of course, we're ignoring taxes right here for the illustration, but you can see, and also because the tax distributions go towards the preferred principal payback. But as you can see, that leaves you with about 600K of cash on the balance sheet. Naturally, if there's growth opportunities, maybe the operator chooses to reinvest and build enterprise value by scaling EBITDA. But assuming it's a steady state business and there's no need for the cash on the balance sheet, they can then distribute that out. So we're also going to assume a 15% preferred return here. So at the end of year one, the 630K of invested capital increases to 725K. That's the PIK. The SBA will not allow that preferred return to be mandated distribute out of the business. To Jordan's point earlier, if they don't want to distribute the cash, this can continue to accrue and continue to build at a very strong return profile. But then if they choose to distribute the 600K of available cash flow, excess of what they need, then the operator gets 20% of that. So that's about 125K. The investors get 80% of that distributed capital, which is about 475K, meaning, you get, at the end of year one, in this example, 75% of your invested capital is returned at the end of year one. And so
I appreciate that.
in this way,
So
it's
this stays in place.
Yeah.
Yeah, go ahead, Wesley.
I was going to say, in this way, it's credit-like downside protection with equity-like upside returns.
Yeah. So
Yeah.
So this is
And
the
so-
example where like the 80%, 20% is until the preferred equity capital is completely paid back. In other words, the CEO, the owner, who actually does have the majority of the common equity, let's say they own 60% of the common equity and investors own 40% or what have you, right? 75, 25. Until the preferred equity is completely paid down to zero, any dollar leaving the company going to anybody has to be split. 80% of it is going to go, 80 cents of it is going to the investor group and then split up pro rata by person, by investor. And then the 20% can be distributed to the CEO and he can take it. But until it's, so he's heavily incentivized to get that paid off or get that paid down. But then he can start to do pro rata distributions once that's paid down. According to common equity.
And
splits.
what is the pro rata once the 100% is paid down?
Yeah, that's dependent on the deal, right? So it's a composite of looking at, really it's ultimately coming out to be an LBO model, conservative base case based on the transaction structure and the size of the deal, looking at what is the preferred rate of return that's expected in the term sheet, for the equity. So in this case, it's 15%, but it could be 10%, right? It could be 12, could be 8. So, I mean, it's if he's going to go at 8%, he's going to have to give up more of the common equity in the model to make it such that you're getting a 35% IRR over a projected 5-year base period. Does that make sense? It's kind of they're factors that modulate to ultimately create the outcome that's projected in terms of the return.
And that final outcome, the final projected outcome right now, as you see it in the market the way it is right now with the 10-year the way it is, what do you see that? And also, do you see it from an IRR multiple or like just multiple in equity? How do you present it?
We do both. We present the IRR and the MOIC that should be expected based on the conservative base case for each deal.
And
I think if the question is what is expected on the base preferred return, rate of return, yeah, I think it's probably going up. That people are going to want a higher base rate, and but ultimately, I think what anybody should look at is the composite expected returns for their investment, which is going to be that, like I said, 35% IRR. Whether you get it through the preferred return plus early return of capital, or it's year 3 or it's year 5,
it's all the same.
Let's say it's year 5, and all of a sudden you get a big windfall of cash. That'll be a lower IRR, or it'll be a little more in line with the MOIC expectations based on like a table. But every company is different in CO.
For this
Go
deal
ahead.
that you're raising, or the Azure deal, what does that look like in terms of expected returns?
Yeah.
Wesley, do you have like a table output of that, or? I think we're in like the 40s.
I can share our teaser on that. It's 48.5% preferred return or IRR. Again, because your payback period for your investment is 2 years, which includes the 15% preferred return. And this assumes 5% revenue growth, no margin expansion, and no exit multiple expansion. So down here, it's a 3.5x deal. Assuming we exit at 3.5, that's how you get to the 48.5% IRR and 3.2x MOIC. Sorry, can you all see that?
Yeah.
Perfect. And one of the questions was, talking about sales efforts and increasing capacity. There is a ton of growth that can occur here through adding a new shift, opening the office on Fridays, so on and so forth. We don't want to underwrite that. We underwrite 5% revenue growth, no margin expansion, and no exit multiple expansion to hit these return profiles, because it's conservative, it's realistic, and it bets on an operator doing relatively bare minimum to achieve these returns.
That's awesome. So what is your
we have a
process?
question here. I was just going to say we don't
ahead.
have any like this the historical profile. I know it kind of declined a little bit in 2020, but we don't care if someone's say it grew 41% in 2021 and 15% last year. We're not assigning a go forward growth rate that's like an average of the last 2 years. We don't do that, and that's to the upside potential of the investors. That's we want to be conservative here. There's a lot that you can't estimate it's going to happen. Maybe the first 6 to 9 months are a little bit tough, because you're transitioning a business from a founder owner, and you're inserting some operational support staff and some sales staff, and they haven't sold anything yet. It's fine. Like, a lot of times what we see in these deals is first year, it's like a transition year. Second year, it's like record. Third year, it's a record again. And it's just like, it doesn't take like an extreme level of unbelievable intelligence and talent to really build one of these businesses in one of these industries into something very meaningful. And I think that's, if you get that part of it, you're probably an investor in the space. You probably are thinking, okay, I want to put money here. I like this. And I like the model.
Amazing.
Guys, if you're a buyer of business coming to you guys, what would you expect as an average IRR that I would be paying a particular the investors in such deal?
But the question was, what IRR would you be expected to deliver to investors in a deal, in a conceptual deal?
That's right. That's right.
You know, the truth is, if you're self-funding your search and you're looking to buy a business, ultimately it is a negotiation. I mean, it's ultimately, it's the right balance of, do you want money? Do you want investor expertise, industry background, and money? In which case, do you think you can raise, $1 million, $2 million of equity at that one price level? There's all sorts of ways to skin the cat. We've developed a way that we believe is sufficiently a combination of conservative and also simplistic enough that it doesn't overcomplicate the finance part of it and really keeps the focus on the quality of the CEO, quality of the business, and the quality of the industry, and the quality of the transaction, the structure itself. But so we've typically targeted anywhere from 30 to 30% plus IRRs. That's us. And the reason is because if you look at the across the asset class over the horizon, you look at the traditional search fund model, and everybody can go Google this, pull down the Stanford search fund study. And in there, you're going to see IRRs expected from investors in traditional search fund deals. And it's about like 32.9% or something was the most recent edition of that. So we know that is the most direct corollary to a self-funded search deal is probably a traditional funded search deal. You're putting the same type of person in who's relatively younger, ideally has had some decent operational leadership experience before they did this, maybe some military operational leadership experience, and you're taking a bet on that person to put it on their back and grow a company. So we figured that's a risk premium adjusted level of return to take for the implied risk of this asset class. They're typically smaller companies, right? These are not on the S&P 500. So you baked all that in, and I think you net out to around 30 to 40% IRRs that should be expected by investors, that I would expect as an investor, personally. I do expect.
Okay. And say you have a total of 3 million coming in to this deal from the investors. I love the idea of the 80-20. So the investors are made whole. So they're going to get their 3 million back. Say it's a targeted of 35% IRR. So the whole incentive there is for the new to take as least amount of distributions as possible, just to pay off that the investor pool. So therefore, you're looking at just a few years, maybe or less, after paying off that investor until you're made whole, until you can pay them off in full. Is that right? Is that the average?
Depends on the deal.
Go
Go ahead, Wesley.
Jordan hit a better point than I was going to make. Depends on the deal. In this deal, for example, it's 1.8 million of equity with a accruing 15% preferred return, and it's paid back in 2 years with the 5% revenue growth. But for example, on some deals we have where it's 5.2x, maybe you're accruing that 15% preferred return over the entire 5-year period, and making at a hypothetical exit, you're getting a lump sum for the outstanding preferred in year 5, and a residual portion of equity to hit that minimum 35% IRR and minimum 3x MYC. It just largely it is financial engineering at its finest, and depends on the multiple, the amount of leverage we're able to secure, and the amount of EBITDA and the equity we're able, the amount of equity we need to raise.
And then also to add to that, the projected timeline, we can project all we want, and everybody knows we can make models in our bedrooms all we want. But the fact is, you're going to discover a lot more about the company once you step into those shoes as the CEO and owner and personal guarantor of the debt, and actually talking with the people that are there. These are not machines. These are groups of humans that are conducting operations in industries. And you may find out that your revenue growth target was way under appreciating the actual opportunity set, in which case maybe you have the capability to pay it all off in year one. Maybe you find out that you actually want to invest a lot of your free cash flow back into high return projects as an operator of the company, in which case you're not going to distribute a penny, because it's a much better use of your capital to go generate a 50+% IRR, as an internal rate of return in the company itself, growing it from, in this case, let's say 18.8 million in revenue to 30. Maybe you want to do that by year 2. Is that a better outcome for investors, inclusive of yourself as the CEO? Yes. So it really depends on, what the opportunity set is. Maybe you want to use some of that excess cash flow to buy up some smaller competitors and do a buy and build strategy. Maybe you want to raise some debt as part of that M&A strategy. So some of our home health, home care, and hospice deals, that's one of the primary drivers of value creation is inorganic growth, doing some of those add-on acquisitions. And for a deal like the one I bought, with the professional services for cities, it's really more organic. There really aren't any opportunities to buy other competitors. There's like a handful of competitors out there anyway, but there's a great opportunity to build a team and generate a high return from that, and may cost cash. So yeah, it all depends.
Of the property of the companies that you've acquired or you have on your portfolio right now, what's the average age of the investment, I guess, and what have you seen in terms of return so far?
Yeah, so it's still early days for because we just started in the fall of 2020. So, we're just a little over 2 years now, and we can see tax returns, we can see financial performance. I'm happy to report that everybody's doing well. Like the companies are either performing at expectation or better than expectation. And also candidly, in the first 6 months, like I think I'd mentioned it earlier in this Zoom, in the first 6 months, there's a handful of those, they experienced some real tough times and they turned it around, and now they're producing record results. So it's just part of buying a small business. It's going to happen. I'll speak for myself personally. When I took over as the owner and CEO of the business, we were kind of flattish for the first kind of like six to 9 months. And I can report that we're also producing record revenue and profitability, more so than we ever thought. I honestly thought we could at this point, and we're about 2 years in. So,
and that's just organic without reinvesting back in.
So what I've done, I can speak to my deal. So I hired a director of operations, I hired a controller, various administrative support staff. We've hired a bunch more junior talent resources that are actually producing a lot of the work. I've instituted new processes, transitioned over to a new ERP, got us off QuickBooks, wasn't sophisticated enough for us. What else? Changed the way we hire, added a new personnel intake, process system, if you will. That's, I think, creating a higher percentage hit rate in terms of when we hire somebody, they actually stick. And we've instituted some sales initiatives to get out there in front of clients, and also some pricing optimization efficiency initiatives. And all of that together, you put it in a smoothie blender. It's so far, it's doing well. So I wanted to continue to do so. And it's one thing as an operator, you're never done. It's every day you got to fight to sustain, if not grow. And you're in competition always.
What is something that you learned from that you learned new as you entered the business, as you took over the business, that you assumed about the ownership and about what it was, and then when you went in after a couple of years, you've learned that was happening?
Well, I would say, one thing in terms of, definitely instilling humility is that this is a niche skill set. The, grant research and writing and management space for local cities And there's a reason, think about this, right? I mentioned it's not very fragmented. There's not a lot of competitors out there, right? Well, that's not great. That means there's also not a lot of people who know how to do this. And it is a niche skill set. So I, definitely didn't have as full of a grasp of how tough it is to really build that talent and water and grow that talent. And I've definitely came to a full appreciation for how much time and effort and internal resources should be spent if we believe that organic growth is the opportunity here, should be spent really being best in class at creating and nurturing early growth paths for careers for people to be with us, and thinking about that as more of a long-term sustainable strategy to grow the business. Because I think we're not so much demand constrained as we are really supply constrained. So yeah, you really can't know that until you jump in.
Yeah.
And you talk to
Yeah.
people.
Yeah,
So-
you become in the talent acquisition game. Okay.
Absolutely. That's true of almost any business, but yeah.
So
That's
is there a
right.
way to reach you guys for investments? And I see some more questions there, but so we just contact Wesley, I guess, if we want to do this. And Hisham, in your study, seems to many find deals in aggregator platforms. Any good ones you can share?
Yeah, so I would actually, I agree with that, Jay. Just like take a break. I think this has been fantastic questions, and really impressed with the nature of them in the group. It sounds like everyone's pretty serious about considering this. If you're searching for business, you're looking to buy something, you can ask anybody we work with. I think we're pretty good partners alongside searchers and future CEOs. Post-close, we actually help them out. We're here if they ever need us, or like, hey, what do I use for this? Or do you have any recommendations of where I can find this type of person? I'll jump on a call with someone, a CEO, and say, hey, let me help you out, or let me connect you up with another guy who's in your industry. You guys need to talk. So so that's post-close. But if you're an investor, if you think that fits your criteria and you're willing to devote to 50K checks, and you think this is a good opportunity to diversify your asset pool, yeah, just reach out. Just get in touch with us. We have a contact us page on our website, and you can even say there, hey, I'm an investor. So I'd love to talk with someone about how to get involved and see deal flow.
Awesome. So we'll try to create a pool within GoBundance of small business acquisition investors, and hopefully we can come in on. I like that deal, the deal that you presented. So I want to learn more. So I'm going to reach out, and if anyone else is interested in learning about that particular deal, let me know. Maybe we can do one call for all of us.
Yeah.
Cool, guys.
Yeah, I'm happy
Thank
to
you,
help with
Jordan.
that. No, we'll touch base afterwards, but I'm happy to
Okay.
help with that.
All right. That'd be cool. All right. Well, thank you, Jordan, for taking the time. Thank you, Wesley. I appreciate you guys making this happen, and I think everybody enjoyed the call, and we'll definitely keep in touch.
Fantastic. Thanks for having us, Jay. Appreciate it.
Thank you.
Thanks,
All right.
guys.
Cheers, everybody.